Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With markets now expecting a Fed cut in September, many investors are wondering if they might need to adjust their portfolios. Given this possible new stance from the Fed towards lower rates, the back to office push, and the AI infrastructure build out, what role ultimately can real estate play in your diversified portfolio over the longer term? And do tariffs impact builder and real estate supply chain costs over the longer term? To unpack the real estate story and how the various subsectors might perform, as well as giving you insights on a topic that almost all Canadians like to talk about, we are very happy to be joined by portfolio manager Steve Fuller. Steve manages the Fidelity Global Real Estate Fund. And just to let you know, this discussion today is available with live French audio interpretation. Welcome, Steve. Great to see you. How are you?
I'm wonderful. Good morning to you.
Delighted to have a chance to speak with you here at the end of August and to sort of put things into perspective for the fall season here ultimately. Let's ask you about the rate story because it does seem to be always linked to real estate. You're going to tell us some nuances about that. But what did you think about the comments out of Jackson Hole and the shift there?
To some extent, I think they're expected that ultimately here in the U.S. we are going to get rate cuts on the short end of the curve. Ironically enough, I'm more concerned what could happen on the long end of the curve, the 10-year Treasury yield, or long interest rates generally speaking, as real estate is more priced off of that, given it is a very capital intensive business.
So capital intensive business makes you sort of wonder about the supply chain story that we just mentioned there. I mean, ultimately there's a rate story there. There's also a tariff story and an inflation story that we'd love to dig into with you. It costs more to build things if you can't get the raw materials. Is that sort of the scope of the story there?
Yeah, no, that's a fair assumption that we have seen hard costs, as they're known in the industry, go up tremendously given the tariff uncertainty. You also have, at least here in the US, the immigration uncertainty has been driving up more of the labor costs. So over the last 4 to 6 months, it's estimated to replicate a commercial building, for example, in the United States, has gone up at a minimum of 5%. So that means you need to justify, that is, have higher rental rates to justify new construction.
And therefore, as an investor in real estate, if rents have to go up to adjust for that, that's quite good actually.
Yeah, no, that is a medium and longer term positive that on the fundamental side of things, does paint a pretty good picture.
Tell us a bit more. I mean, maybe we'll go into demographics for a second to sort of get to that demand story. We hear a lot because of interest rates. People have stayed put. Is this going to ultimately change mortgage rates if we see cuts from the Fed, in the next couple of weeks or so? Will that impact? Will that unstuck the market? That gets discussed a lot at the high level. I wonder if you can bring your perspective to sort of rates going down and unleashing some animal spirits that aren't there right now in the real estate market.
Yeah, no, the demand for all forms of commercial real estate have a high correlation with GDP and job growth. So if these animal spirits are released, that is, GDP growth goes up or the employment rate goes up, that is a very good demand side equation for all forms of commercial real estate.
But should we think, I mean, for instance, last year when the Fed cut rates and it was in this September, it was a monster rate or discussed that as 50 basis points. It's a different market then than it is now. But should we be expecting that to, create the conditions for a better mortgage deal for people to then have more demand?
We would anticipate that, but there is something I often, though, besides the fundamental side of the story, besides the capital or the interest rate side of the story, there's, to some extent, what's going on in the rest of capital markets. We've often seen in the past that global REITs will trade as much as a reaction to how equities are trading, whether they're trading well or poorly, and especially the growthier part of the equity market. For example, the NASDAQ, which is a great example of growth stocks, where we've seen when that has performed well, unfortunately, REITs oftentimes don't perform as well. But I tell people, for example, last July, when there was a correction in the NASDAQ, what was one of the best performing sectors or asset classes? It was REITs. Earlier this year, that also held true. And then even more recently, we've seen a little wobbling with the NASDAQ, and the REITs have done well. So this once again reinforces that diversification benefit of why you want to include a portion of any portfolio in real estate stocks or REITs as kind of a ballast to the growthier part of the equity markets.
Which is, as you say, sort of the whole one of the purposes of it. But it's an interesting. I don't know if it's contrarian, but it just seems like we stare at interest rates to get a sense of how lots of things that are interest rate sensitive, like real estate, will perform. And you're actually saying take a look at growth stocks maybe for a better cue.
Take a look at the growth stock. There's been an increasingly negative correlation of the performance of REITs or global real estate, listed real estate, and the Nasdaq. So I tell people, let's look at more in a triangle and not just looking interest rates, performance of REIT type world.
We've seen a big international discussion for equities, particularly around the world investments through this year. It's been one of the hugest themes. Is it the same for real estate for you, particularly?
Yeah, I mean, this global real estate fund primarily invests in the developed world.
Okay.
So, and a lot of the same thematics kind of permeate throughout the world. That is, what are the fundamentals? We continue to see around the world the amount of new competitive supply fall off. One, because the cost to replicate is also reinforced throughout the world. Second, the cost of capital, that is often driven by interest rates, it has kind of stabilized throughout the world. So if we have some of that stabilization of that interest rates and that cost of capital, that can lead to, I'd say, lower cost for interest rate. And secondly, it can also lead to more what I call accretive investments. Because the REIT structure, you have to distribute the majority of your cash flow out in the form of dividends. So often REITs have to access either the equity or debt markets to make acquisitions. And we're starting to see in some cases where they're accessing both the debt and the equity markets and making accretive acquisitions, which then leads to external growth. So in addition to rental rates going up, if you add external growth to it, that is a double positive.
That's fascinating with rents going up. I have to ask you about back to office. This has been rolling for some time. There does seem to be a bit more of a push right now, and particularly for sort of the fall season. Does that mean suddenly there's a demand for that type of real estate? Is that sort of happening right now?
Um, yeah, I mean, look, most corporations, when they sign an office lease, are making long-term decisions. So it really has less to do about the seasonality of it. I'd say that the return to office, it's less, we've kind of, what we see in the statistics around the world has started to plateau in what I would call this new normal post the COVID period. That is, yes, most people have some form of remote work. Yes, the office isn't dead. But at the same time, we're still seeing some degradation of demand for office on a long term basis, especially in North America. I mean, I tell people, even though the office market is slowly recovering in major cities here in North America, like Toronto, like New York, like San Francisco, the occupancy rate is not yet to its pre pandemic level. And secondly, for example, office REITs in the US, their cash flow growth in the latest quarter was down more than 5% year over year. So even though leasing is occurring, it is still a very tough and difficult business. And that's one reason why this fund has, for an extended period of time, been underweight North American office. Now, outside of the US, the office lease is better. Return to office is higher. It never got as beat up in cities like Tokyo or Hong Kong or Singapore. So the fund does have exposure to office in those markets.
We sometimes read headlines, you'll put us straight, about people moving out of cities because of all the things you just mentioned and what's more available in terms of remote work, or even just to different cities, for instance. Are centers of population dispersing because they can? Do you see that in terms of investment? Do you want to, invest more rurally or more maybe, I don't know, just outside of cities or different cities?
We saw that obviously during the COVID period. We've seen some return, actually, ironically enough, to major cities. When, for example, an Amazon in Seattle calls their employees back to the office, the apartment market benefits the most, where we see leases on apartments start to go up in those markets. At the margin, I think you're going to see, this the remote work is a fact of life. It's usually the second decision whether someone takes a job outside of the salary. What is your policy on remote work? But I don't see you're going to see large influx or outflux anymore due to these types of reasons. I think it's kind of reached a more normal state.
That's really interesting. As you said, plateau, like it's sort of, from an investment perspective, that's happened already.
That's already happened, yes.
So I have to ask you to go to long-term rates for us, just as they relate to the real estate sector, which they may not. I mean, there's a lot of discussion about the 30-year bond and the dollar because there's a lot of pressure on the Fed right now. The story of the day is the administration's high pressure on some of the Fed officials. It's more about what it means for an institution and ultimately what it does to sort of the investment case. Is that something that you're looking at? Is that something that you're pricing off? Is that something that we should think about when we think about real estate?
I do, price off of or think a lot about long-term rates. I do, though, use more the 10-year government yields just because you can compare them more around the world to 10-year gilts, 10-year JGBs, 10-year bunds. So the 10-year, and at the same time, the 10-year is what most, when XYZ REIT issues corporate debt, for example, they're primarily issuing 10-year debt. So you get a factor of what their cost of debt capital is going to be off of that. On the flip side of it, absent the shorter lease duration sectors such as apartments and lodging and self-storage, most leases, even around the world, are more longer term in nature. On average, they can be 10 years. So you're in some extent, a company issuing 10 years is trying to match at the same time their asset side of the balance sheet so that they don't have a mismatch going on between assets and liabilities.
Right, it's really interesting. And with the discussion of tariffs and inflation, which is linked to everything that we're talking about with interest rates, certainly, you've been modeling for months now the effect of tariffs and the inflation, as you say, to build a similar building and replicate is maybe 5% more than it was due to tariffs. I guess the question here is that something we can put in the bucket of transitory? It is a one-time, there will be some adjustment around that. Do you have clarity at this point, now that you have that general number?
I don't know if there's ever going to be clarity. I do think it's a step-up function, and we do assume it's not going to go down. So it's not only the hard cost, but it's also the soft cost of labor that I mentioned earlier. So we do assume, because oftentimes you don't see huge deflation in kind of the value of a building or the replacement cost, the ability to replicate that building, what it will cost to do that. So we don't anticipate it to come down.
Okay, that's really interesting. In terms of what is interesting across the data center build out, the discussion of AI, that seems to be firing on all pistons from different angles within the investment community. The data centers are getting built. Can they be powered? There's a sort of a question about the location of them. I'm curious where your investments lie now, where you're interested in now in terms of that story.
Yeah, now the data center business on a global basis, it's the one sector where we are seeing tremendous supply growth. But at the same time, it's meeting tremendous demand growth. The vacancy rate for existing data centers is as low as it's ever been. Now, data center, which in its simplest form is just a huge chilling thing of all the heat that's being generated from all the chips inside. So you need tremendous access to power, increasingly to water, but also to fiber, that latency issue. So right now, with the AI demand layered on, most people can run kind of their training models, if you will, anywhere in the world.
Okay.
We're being more specific in where we're looking at the companies and their investments where there's latency. So once you apply these AI models, people will want latency. They don't want a little rolling thing on your phone or on your computer waiting for the answer for something. And that's measured in milliseconds. So that latency does matter. So when we're looking at the data center REITs, that where they own these things, that there is this is not in the middle of nowhere, which there is quite a bit of demand right now just because of that cheaper access, especially to green power.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Well, okay, let's pick up on that middle of nowhere, because that's where there's space and sometimes power, and also sometimes cold temperatures that are useful. Thinking Canada, actually. But so when you say middle of nowhere, it's just a longer hookup to get to the power, the sort of population centers ultimately. So can you be more specific? Where are these places that are of interest? Are they on the cusps of cities?
No, I would say there we're seeing up in Norway, for example, or up in Alberta, or in the middle of the United States, the Nebraskas of the world. Those are where these large data centers are being built, where there is cheap access to power. But and they're great for some functions. I'm not belittling that, but oftentimes you can see though, when that lease comes up in 10, 15 years, will that hyperscaler still need that space or that data center space because they've already run their training models? Or will they want more that's closer to population center because of that latency issue? So that's something we're constantly evaluating and looking at.
Okay, and so the investments, may shift there because of that, or it may shift the actual location because of that.
Yes, and like as many of my investors are looking at me, how I allocate capital. I'm looking at, for example, the data center space and how they're allocating capital. And many of them right now, at least on the public side, they're not really involved on the data centers that, and I'm exaggerating, in the middle of nowhere. They'd rather be someplace where there's latency, where there's interconnection, that is, where you can connect to another, on or off ramp, the internet. So those are the type of investments that we're primarily looking at and seeing in the publicly listed REIT space.
And how many of those companies or clients or companies that you're interested in have a plan within it, maybe not today, but longer term, for nuclear, or if not nuclear, what other types of power are they accessing? It tends to be a version of clean power, it seems like. I mean, they're not using heavy oil for them necessarily. What other power sources?
No, there's a high desire for anything green related. Unfortunately, given the huge demand that we're seeing on a worldwide basis, some of those green functions are falling a little bit to the wayside. And natural gas is one that's often the first choice to use the power. And then look, this is also going through any local jurisdiction's utility system. So it's not necessarily the data center itself that is making that decision. It can be the tenant, what type of power you can hook into. It could be a variety of type of things. Where we're seeing people access nuclear power, for example, that's inside the meter is the term that they use. That's usually the hyperscale themselves that are building that in conjunction with that type of power.
Is there any other area within there that is an interest? I mean, at one point, for instance, to own the land that the cell towers are on was sort of the big deal. We're kind of talking about a similar situation with the land the data centers are on. But is there something that stretches within the fund or of interest or within the universe of what you're doing that actually goes to sort of the power side of things, or not?
Yeah, no, it's interesting because many of our logistics REITs that we own, they're a little bit under the radar getting involved in data centers. That is because many of their current logistics sites or even development sites have access to power. And it's a typical term in real estate is HBU, higher and better use. And because of that access to power, it has a higher and better use to be a data center than a logistics facility. So we're seeing some current logistics facilities be converted to data centers, or secondly, their development pipelines, they have data centers. And the value of a data center, at least today, can be 2 to 5 times more than a typical logistics facility. So that in and of itself is exploiting that current land value, which is all about that access to power.
That is fascinating. That is so interesting. Tell us a little bit about maybe a couple of thoughts on the Canadian market. Broadly, we can go to the commercial side of things. At one point, I remember you saying sort of central Canada in terms of multifamily, looking at REITs there. there's a lot of rent control coming in at one stage. There are better opportunities in other parts of the country. Well, currently, what are you looking at within Canada?
Currently, I'm kind of looking at two things more than anything. Obviously, the apartment market, and you can, in a very simple way, you can dissect it by where it's more rent regulated in the eastern part of Canada, and then it's more market based in the western part of Canada. And we have exposure primarily to the western part where it's more market based. At the same time, there's a few clouds on the horizon, though. This is quite well known with immigration policy in Canada, because majority of immigrants end up firstly renting an apartment. So on the demand side of things, there's been a slight downtick in demand, just given the population, or I should say, not negative population growth, but less population growth going forward, and what that will mean for the demand side.
Okay, so that's sort of an evolving situation ultimately. Around the world, you mentioned this, it is always a global fund. There are areas of exposure through Asia historically. Or do you still have some of those exposures?
Definitely. I have very much like the Japanese market, and there's two sides to the Japanese market, what's called the J-REITs, or the REIT structures themselves, and secondly, the developers. And all the developers, though, 80 to 85% of their revenue comes from just leasing. So it's very similar to a J-REIT, but also in the term, they're involved much more in the development side of it. All of them, the developers, have a large exposure to the Tokyo office market. And we're seeing now, the vacancy rate has gone down almost to 4%. We're starting to see very strong rental rate increases. So we have exposure primarily through these Japanese developers, which have large exposures to the Tokyo office market to benefit that. They also, in addition, trade, or historically have traded at quite a discount to their net asset value. So this is one way to play a fundamental improvement, in our opinion, at a discounted valuation.
It's really interesting. Would you say right now there are large areas of sort of big bets and conviction, or is it more, you just mentioned a fundamental way to get access to a very good investment? Which strategy are you using more right now?
I'd say it's a combination of both. If I had to use, and I have these very long-term little boxes to what I call my emphasis on positioning charts. And that's not to say that this is any top-down positioning, if you will. Today, it's much more neutral. That is, that the fund currently, and how it is kind of chosen, is from twofold: good fundamentals at the best price. That's more of a normal state. So there's not any big thematic going through that we're trying to make large bets on any sector or country at the moment, but more individual stock.
Okay, really interesting. Again, areas within some of the subsectors. I think in the past we've talked about assisted living. This is throughout North America. I don't know if it extends to further abroad, but it was an area that you were interested in. Is that still the case? Is that still growing after COVID?
Yeah, no, it's a North American phenomena, and it's primarily private pay. Now, there's healthcare related kind of properties and actually REITs around the world. But outside of North America, and even various sectors, it's more government pay. In government pay, there's usually not a lot of growth, and there can be at risk that governments want to change the amount of reimbursement rate. Where assisted living, that is, primarily when, unfortunately, as many females at the end of life, that's just an actuarial statement, plus 80 years old, they can no longer live, unfortunately, in their home, and they'll go to an assisted living community. And the amount of 80-year-olds in both the United States and Canada over the next couple of years is going to increase tremendously, where at the same time, the amount of supply of new beds is actually going down. So we're seeing occupancy rates tick up and the ability to push higher rental rates higher. And because this is private pay, you need to have the wherewithal, where the average length of stay is about 22 months. And given how much we've seen over the past few decades in stock market appreciation and home price appreciation, those two are the primary source of funding for this length of stay when, unfortunately, right? The mother or the grandmother goes into one of these facilities.
So that's a North American specific story for you. What is a more global discussion? I mean, I know anything kind of anchored by groceries is often a very good area. Is that something that's a pretty global story for you?
Yeah, no, on the retail side of thing, the fund does have an emphasis on what I'll call non-discretionary, kind of tenants, that is supermarket anchored retail centers, whereby you do get a tremendous amount of traffic driven by that weekly or bi-weekly visit to a grocery store. And neighboring it can be a variety of nail salons to a post office to a FedEx store to just general daily needs, a coffee shop, for example. So and we've seen around the world a lack of new competitive supply, which started actually about 15, 20 years ago with the advent of e-commerce of all things. So supply of new competitive has gone down, whereby, the amount of kind of e-commerce disruption has also started to plateau around the world. So we're seeing these retail tenants have the ability to pay higher rents. At the same time, the landlords have increasing leverage to extract higher rents.
That's fascinating. It's sort of a story as old as time to an extent, the marketplace where you need to go, and it's a good bet that way. Is there any just final thought you would leave us with in terms of either your positioning or really the place in a portfolio where this can really help investors stay the course?
Yeah, I can't emphasize enough, and I know I'm repeating a little bit, but the growthier part of the equity market, when it works, we all love it because so much market cap around the world is now in the growthier part. But when it does, for example, take a little breather or, God forbid, it takes some type of correction, historically we have seen where kind of income-oriented real assets with limited amount of high total return, but it does have a relative place in a portfolio. So I constantly emphasize that.
And isn't it interesting how little actually we've spoken about rates, because there are just so many other things that fold into the story and the way that you invest.
Yeah, no, I mean, the actual long-term correlation of the performance of global REITs to interest rates is actually close to zero, which surprises people. That's not to say over a shorter or medium period you can have periods of higher correlation, but the statistics bear out that over a long period of time, there's very little correlation. So it's one of my little minor pet peeves that this is always perceived to be this interest rate sensitive vehicle. That's more perception than reality when viewing it on a long-term basis.
Grateful for you joining us, setting us straight, and actually really informing us about how you are driving the fund through this particular environment and every day. Every day is a good day to talk about real estate.
Every day is a great day to talk about real estate.
Steve Fuller, thank you for joining us on Fidelity Connects.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.